Duco, it would be good to get your sense, I suppose, of what we're seeing at the moment in terms of the financing markets.
Happy to do that. Many thanks, Richard. I think on the finance market, what we see is transactions is obviously slowing down. Banks are getting less prepaid following less disposals in the market. And I think overall liquidity is less compared to previous years. Banks need to hold more equity following increased regulations. That's one element. Second element is that they're getting less money back following no transactions happening, so nobody's prepaying their debt. And ultimately, they're focused on the cash flows, and interest rates have increased so much that LTVs needs to come down. So banks are really conservative. They're focusing on their own clients, but they need to be very selective with their equity and see where they can deploy their liquidity.
And in terms of the I suppose the outlook for you as a borrower, how do you see the interest rates, and what does that mean, I guess, in terms of the accretive nature of financing?
What we have experienced since summer last year is not only that interest rates went up and that interest rates increased, but more important, they increased every time more than the market were expecting. So that volatility in the interest rates was very difficult. It was difficult for us as asset manager to underwrite your cost of debt in the long term, because overnight interest rates increased further. What you see now, June 2023, is that interest rate seems to stabilize. But you see already in the swap rates, in the long-term swap rates, 5-year Euro swap trading at 3%, you see it's calming down a bit. The volatility is coming down, it's more stabilized, hence it will be easier for us to put it in our underwritings.
In terms of the market at the moment, when do you expect to see this beginning to change? Or do you think we're really here for a long term now in terms of this sort of interest rate level?
The interest rate level in Europe, I think, will stay at least for another year at these levels. Yes. Why do I think that? I think inflation in Europe is coming down, but it's not coming down that rapidly that the ECB will decide to lower their rates. And only once inflation is at that preferred 2% with an outlook to stay at 2%, then they will consider to lower their rates. That's contrary to the UK or the US. In the US, the Fed will maybe even at year end already drop for the first time, or otherwise early next year. But I think the ECB will do that definitely at a later phase.